The game is not over. The game is just beginning. Watch the spreads. That silver is about to do, again, waiting on that trigger level, spread, silver, gold, to go into a new reality. And it's not going to do it incrementally. It's not going to go from here to $150, $200 or something like that in a matter of, a year or so. Like if the stock market breaks, as we argue it's in process of doing, that money goes somewhere. Well, silver and gold are pretty small markets compared to the stock market. And especially the miners are a tiny little market. You move much money from the stock, but look what's happened to GDX recently.
In a recent market analysis, financial strategist Michaeloliver highlighted that the real game in precious metals has only just begun. While many investors believe the bull run for silver and gold is nearing its end, Oliver argues the opposite. According to him, the spread dynamics between gold and silver are signaling a historic setup that could soon redefine how these metals are priced. Oliver explains that the silver market is approaching a trigger level, a point where price action and spreads will no longer move in small, predictable steps. Instead, he anticipates a sudden and powerful revaluation that could send silver skyrocketing. The magnitude of this shift, he notes, could push silver far beyond its historical highs as investors flee from collapsing stock markets and over-leveraged assets. As equities show signs of breakdown, capital will seek safety, and with gold and silver markets being comparatively tiny, even a modest shift in capital flow could cause massive price surges. The recent strength in gold mining stocks like GDX offers an early glimpse of that transition. The game isn't over, Oliver insists. It's just beginning. If you found this helpful, like, share, and subscribe. Turn on the bell so you don't miss any updates. And comment below to share your thoughts on gold, silver, and the markets.
And whenever gold breaks out versus the S&P and surges in performance, it always converts into net price gain for gold. So what people are talking about, gee, this has got to be over, it's gone ballistic, etc. Two things are wrong with that. One, the spread is just about to break out versus the major asset category, meaning the game just beginning. And secondly, gold is only fourfold off of its prior bear low. Back in its 79 peak, the 1980 peak in gold, and at the 2011 peak in gold, it had had an eightfold bull market to get to those highs. We're only fourfold right now. When that spread breaks out, it says something's beginning, okay? It's not saying, it's over. It's saying the race just began. And there's another spread that's very, very important, and that is between the gold measured against the U.S. stock market. And we've run numerous charts on that, especially last weekend's report where we went back to 2013. During that time, 11, 12, and 13, gold peaked and was headed down into a low that ended in late 2015. Well, obviously, during that time, gold was underperforming the U.S. stock market because it was really going down hard. And therefore, the spread was negative. Gold was underperforming. But since, actually go back 11 years now, but from 2014, that spread chart, when you divide the price of gold into the S&P 500 and express it as a percent and simply plot that chart month to month, has a massive, super clear ceiling on it that you're bumping and bumping and bumping. It's now for the fourth time, okay? Right now, the spread, if you divide gold into the S&P, is at about 58.5% price of D gold divided into S&P 500. If you ever close a month at 60%, you blow that entire structure out and gold breaks out to the upside. This is a fresh signal, which when that occurs, it's not old. It's not saying, gee, I'm an old trend. It's saying, I've just begun a major asset class shift. Now, when you do something else that we thought we should do in the weekend report, and sure enough, we were glad we did it. We know the S&P is distorted. It's like NASDAQ 100. In fact, you go to the top 5 or 6 stocks in both indexes, and you'll find that those stocks constitute 30% of the entire S&P 500. And you know what those stocks are. AI tech related. NASDAQ 100, the same symbols, 4 or 5 or 6 of them, constitute 50% of that entire index. So they're heavily front-end distorted, especially silver, because some people connect it only as an industrial metal, and therefore if the stock market goes down, silver must too. Okay, they're making a mistake, okay? But you can see it in the hourly ticks where the short-term traders say, S&P just dropped 5, let's sell silver off, it drops 25 cents, and the game is going on still. It's a wrong thought process. because when you stand back and look at the bigger picture, so take, for example, S&P made a high January, February, collapsed into April, 20% drop. What did gold do during that time? It exploded, not hour by hour, but month by month, okay? So S&P had a sharp, cataclysmic 20% drop. It scared most people, most of that occurring in several weeks of March and April. So it was really, almost crash-like, and yet gold went up, okay? So people need to rethink that assumption because it will trap them into missing something if you follow them. In other words, once you get silver up to a monthly RSI that's overbought, if you get out there, you're going to miss the move. Even back in, I think it was 79, you got monthly RSI above the what is the overbought level, stayed there for like 5 months. In other words, you should have bought the overbought level because it stayed there for 5 minutes, it exploded. In other words, all the norms get smashed. We have a situation in silver where, for some reason, and one reason may be the artificial suppression of the market by certain banks, maybe inclusion with central bank, I don't know, where it stayed in a 50-year range. You go back and look at copper or lead. We ran those charts a few weeks ago, go back to the 1970s, and you'll see that they were in a range, 1970s, 80s, 90s, into mid-2000, like 2005 or 6, where they were stuck in this orderly reality, up, down, up, down, up, down. And when they came out of it, literally in a few quarters, they quadrupled in price. These were different times. They weren't doing it together. Copper went up in like 2005, 6. Lead went up in 2007, so it wasn't the same driving force. But they quadrupled in price. And then since then, they've lived in a new zone of reality that's like 4 times the average price of that prior zone of reality. How come silver's still in the prior zone of reality? Look at gold. I mean, where was it in 1980? $850. Silver was 50. Okay, where was it in 2011? 1920. Where was silver? 50. Gold's 4,000. Where's silver now? 48? Okay. What's going on here? We know silver's in great demand by high technology. Solar panel production. Chinese are about 80% of that market. They need silver in the cells. And there's also AI demand for silver.
Market analyst Michael Oliver believes we are witnessing the early stages of a major revaluation in gold and silver. Not the end of a bull run, but the start of a much larger one. He points out that every time gold breaks out against the S&P 500, a move away from risk assets toward real money. Despite claims that gold's rally has gone too far, Oliver argues the data tells a different story. Gold has only risen 4-fold from its bear market low, while past cycles saw 8-fold surges before peaking. The critical signal, he notes, lies in the gold to S&P spread. If that ratio closes above 60%, it would mark a breakout confirming that gold is outperforming equities, the beginning of a fresh global asset rotation. Oliver also emphasizes the distortion in today's stock indices, dominated by a handful of AI-driven tech giants that mask broader weakness. Meanwhile, silver remains suppressed within its decades-old trading range, particularly from solar and AI technologies. History shows that once metals break out of such long consolidations, they often reprice violently higher. Let's get into the interview.
Spread relationship and the momentum of that, which we plot every week in our weekend reports. The momentum of that spread, which requires going from like above 1.2 to 1.32% to be precise, to break out. Momentum of that is already pushing at the breakout levels. And usually momentum will lead a spread chart breakout. So anyway, enough said on that, but that's what I would look at. See silver back above about 48.09 next week. Okay, we'll get one more day this week, okay? And I'm going to break out of that base. So all you do is spin your wheels here. And I think that's what it's doing. I think it's next to meaningless. I know every time we get one of these, there's a whole crowd of internet analysts that say, I got to go to $40 or 41 or whatever, and this is this of the that and so forth. And I don't see it. I see it as a pullback buying opportunity. In fact, I'm making a list right now of miners to add to, because I'm shifting not just into silver related, but also the silver miners. As far as upside, the key trigger for us, and we've stated it over and over for the last month or so, has been the spread relationship between silver and gold. Not the net trend or the momentum of silver or gold, but the relationship between the two. Because we've examined back in the past, and when silver goes ballistic, and again, within that 50-year range, which is ridiculous, I'll comment on that in a minute. $50, $50, $50, the surge that got you up to those levels in the final phase of the 79 to 80 bull, or 2010 to 11, where silver went up fourfold in 5 months, or went up 2.5-fold in 6 months, 2010 to 11. And we know that when silver price goes up, it doesn't induce necessarily more silver production. Why? Because most of silver production doesn't come from silver mines. It comes from base metal miners who are primarily motivated and focused on getting copper out of the ground or magnesium or whatever. And silver is just marginal to them. Therefore, if silver price doubles, it's not really that much of an incentive for them to produce more. If silver matched lead and copper, it could go to $200. Okay. Now, and also, if you go back and look at 1980 high at 50 or 2011 at 50 and factor in the decay in the money in it, the buying power, the real buying power, the dollar, not the dollar index that's measuring paper versus paper, but the dollar quantity almost doubles every decade. 90% increase in the quantity of M2, Well, if you factored that in, silver probably be $200 now just to match those highs in real dollar terms. Wouldn't be exceeding them, it'd only be matching them in real dollar terms. So all kinds of things point to the acceleration phase going dynamic into a new reality. Like if the stock market breaks, as we argue it's in process of doing, that money goes somewhere. Well, silver and gold are pretty small markets compared to the stock market. And especially the miners are a tiny little market. You move much money from stock, but look what's happened to GDX recently. Would you go from 40, 50 up to 80, $80? Bam, like that. That's a new reality. And therefore, the action of these other categories is very important to further fuel the monetary metals.
In the latest market analysis, veteran strategist Michaeloliver explained that the current setup in silver isn't a crash signal. He pointed to the spread relationship between silver and gold as the real trigger to watch, not just the standalone price action. Historically, when silver breaks out relative to gold, it doesn't move gradually, rewriting its value structure almost overnight. According to the data, silver's long-standing price ceiling near $50 is a relic of the past. Adjusted for decades of monetary expansion and inflation, that same level in today's terms would equate to nearly $200 an ounce, just to match its former real-world value. Despite that, silver remains heavily undervalued and underproduced. Most global supply comes as a byproduct of base metal mining, meaning price spikes do little to boost output. With global debt rising, fiat currencies eroding, and equity markets showing signs of stress, the setup for an explosive move in silver and gold appears stronger than ever. Once the momentum breaks above the key levels, the acceleration phase could redefine the metals market entirely. If you found this helpful, like, share, and subscribe. Turn on the bell so you don't miss any updates. And comment below to share your thoughts on gold, silver, and the markets.